In 2008, the world watched Wall Street crumble. A financial earthquake shook the global economy. Banks were thriving, loans were flowing, and confidence was at its peak. Behind the scenes, a housing bubble was inflating, ready to burst. Subprime loans lured people in, loans they could not possibly repay. The financial giants were sitting on mountains of hidden risk. Then, the first signs of market collapse appeared. September 2008, Lehman Brothers fell, sending shockwaves across the world. Everywhere, fears spread like wildfire, from Wall Street to Main Street. Governments intervened, bailing out banks to prevent total collapse. The crisis went global. Economies across continents were staggering. Millions lost their homes, dreams evaporating almost overnight. Jobs vanished, and unemployment soared to record highs. Over time, intervention helped stabilize the financial system. The world learned harsh lessons about risk, greed, and regulation. Even years later, the crisis shaped behaviors and policies worldwide. But out of chaos, innovation and reforms began to rise. New banking practices, increased regulation, and technology reshaped finance. People became more aware of economic risks and personal finance. And yes, even in tragedy, there's a darkly comic side to human folly. The path to recovery was long, but gradual reforms guided the way. The 2008 crisis changed the world forever, a stark reminder of the cost of greed and risk.